Hey there, founders! It's Startup Coach Manoj, and welcome to Startup Growth Hub, the place where we talk about real startup strategies without the fluff. Now, let me ask you something. Have you ever wondered how much is my startup really worth? I mean, you have put in all the hard work, the late nights, and endless cups of coffee, but when an investor asks, what's your valuation? You don't just want to pull up a number out of thin air, right? This is exactly what we are tackling today. 10 proven methods to value your startup. Some are perfect for early stage startups, but some work better for scaling companies. But by the end of this, you will have a solid understanding of how investors think. Let's jump in. Alright, let's start with something that sounds fancy: discounted cash flow or DCF. This method looks at how much cash your startup is expected to generate in the future and then discounts it back to today's value. Think of it like this: would you rather get 100 rupees today or 100 rupees a year from now? Exactly. The money loses value over time. DCF is great if your startup is already making money. But if you're still in the early stages, without predictable revenue, this method can be a little bit tricky. Next up, the venture capital method. This one is all about the investor's point of view. VCs look at your potential exit value and then work backward to see how much they should invest today. For example, let's say they expect to sell your startup for 100 crore rupees in 5 years. If they want a 10 times return, that means they won't be investing more than 10 crore rupees today. This method is common in the startup world. So if you are raising VC money, venture capitalist money, you need to understand it. Here is an easier one: market comparables, also called the multiples method. Instead of complex calculations, this method looks at similar startups that have been valued or acquired recently. For example, if a competitor got valued at 5 times their revenue, investors might apply that same multiple to your startup. It's like real estate. If houses in your area sell for 1 crore rupees, that's roughly what yours also worthing, right? This one is popular among angel investors, the scorecard method. It's basically a comparison game. Investors look at other startups in your industry and score you based on factors like your market size, product, and team strength. If you stand out, your valuation goes up. If your competitors are stronger, your valuation might be lower. Simple, right? Now, what if you don't have revenue yet? That is where the Berkus method comes in. Instead of looking at financials, this method assigns value to things like your idea, prototype, and the style of execution. Think of it as a checklist. Do you have a great product? Do you have a strong team? Are you solving a big problem? Investors add up these factors to estimate your worth. Okay, let's talk about something a bit more detailed. The first Chicago method. This one takes 3 different scenarios. 1. Best case. Your startup takes off. Second one, worst case. Things don't go so well. And third one, expected case, somewhere in the between. Each scenario gets a probability, and the final valuation is a weighted average of all. It is a smart approach, but it requires a lot of data. Here is a simple one: the cost to duplicate method. This method asks one question: how much would it cost to rebuild your startup from scratch? If it takes 5 crore rupees to develop your tech and hire your team, that's your baseline valuation. But investors won't be too impressed with just cost, they also care about your future potentials also. Every startup has risk, right? This next method, the risk factor summation method, starts with a base valuation and adjust it up or down based on risks. Things like market competition, legal issues, or even your team's experience can increase or decrease your valuation. More risk, lower valuation. Less risk, higher valuation. This one is more traditional, the book value method. It's simple. Take your total assets and subtract your liabilities. Whatever left is your valuation. The downside, it doesn't factor in things like brand value or future potential. That is why startups usually don't rely on this alone. And finally, the precedent transactions method. This one looks at past acquisitions in your industry. For example, if similar startups were acquired for 50 crore rupees, investors might use that as a reference for your valuation. It's based on real world deals, which makes it practical. So, what is the best method for valuing your startup? Well, that depends on your stage, revenue, and industry. The key is to understand these methods so you can have a smarter investor conversation. And hey, if you want to dive deeper into funding and growth strategies, I host free webinars where we break down topics like this in even more detail. Plus, you will get to network with other ambitious founders like you. Join the vibrant community today. The link is in the description. So, if you found this valuable, hit that like button, subscribe, and turn on notifications so you never miss a startup tip. Thanks for watching, and I will see you in the next one.